Three precious metals bull markets that I've lived through, at some point in time, silver decouples from gold. Perhaps we've seen that in the last 4 weeks. And when that happens, for a time at least, the gold price seems to, the silver price seems to move twice as fast as the gold price. One would expect from the period that breakout occurs for silver to outpace gold roughly 2 to 1. Therefore, if you believe that the gold price for the balance of this bull market goes up 300%, it would not be out of line about the exchange traded derivatives. The ETFs, the Sprott physical products, because I
We'll
think
get
those
there.
are accounted for in the silver market. The claims that have always bothered me are the claims in the futures market. It is not uncommon for the daily volume of futures obligations in the silver market, the daily volume, to exceed by a factor of 200 times, not 200%, but rather 200 times the amount of physical silver available for good delivery. This is an extremely, extremely leveraged market. Now, virtually all of those claims, until very recently, cash settled, which is to say they weren't held for maturity. They were rolled over, whatever happened. Very recently, because of location disparities, which is to say the London market not having enough gold, there was a location premium for gold in London. And what that meant was futures holders in the US would actually take delivery of the physical silver and ship it to London to take advantage of as much as a 4% disparity in the London quote and the Chicago quote that was contemporaneous. A 1 day 4% premium. When that happened, the gold lease rates in the United States skyrocketed because rather than leasing gold, it was easy to make 2 or 3 or 4% simply shipping that gold to London. What has always scared me was an imbalance between supply and demand, between the physical gold and that paper gold, if more people stood for delivery. Make no mistake, Michelle, if you have a real imbalance in the futures market, you are not going to engineer the massive short squeeze that the silver people hope for. What the exchange will do is that they will halt silver trading. They will set an arbitrary price between buyers and sellers, and they will cash settle. That's what will happen. The exchanges run for the exchange members' benefit. That notwithstanding, that sort of market turmoil, what is likely to be the agreed upon cash settlement price, were that shortage to occur, I think would likely be dramatically higher in the circumstance that we see today than the price is today. And the dislocation in a market where 200 times the claims, where there are 200 times the claims relative to the amount available to settle on a daily basis, is a market that's really, really, really ripe for disruption.
When you say 200 times, you're saying is that like a 200 to 1 ratio?
Yes. Now, that doesn't happen every day, but there are days when, if you look at the physical silver available in North American futures markets, on the COMEX as an example, good delivery silver in system available for the settlement of the claims, it is not unheard of to have 200 times that amount of silver traded in contracts on a daily basis. Now, the huge majority of those things cash settle. They aren't presented for delivery. But in a situation where you have these goofy location swaps, 4% difference in spot price between London and Chicago, it's very tempting to take delivery, ship it, and grab the money. So all of a sudden, you had a situation where the held for delivery proportion of those trades relative to the cash settlement portion of those trades went up, and the COMEX got stressed. I'm sure that your channel's employer, has also seen a remarkable shortage of small denomination physical silver products, the 1 ounce products, the 10 ounce products. We've noticed at Sprott that there is no shortage of silver available to us in good delivery in wholesale quantities. In other words, the bullion banks have been able to supply Sprott with the physical silver that they need. But the dealers have had a very difficult time keeping retail denominations in stock. They've also had a very difficult time hedging their silver inventories and leasing silver inventories to make available inventory to their clients on a short-term basis. There's been a dramatic turmoil in the silver market. Your own sponsor being one of the few that seems to have been able to stick handle their way through this crisis in good order and service their clients.
How does this ratio of 200 to 1 in the precious metals market, and I guess silver in particular, how does that compare to other assets?
I've never understood it, first of all. The idea that the price of a substance should be dependent on its relative abundance or scarcity in the Earth's surface doesn't make any sense to me. It's a good way to generate commissions or sell newsletters, but that ratio doesn't go to utility. It doesn't go to production cost. It doesn't go to stock versus float. The idea that silver should be, or that gold should be 16 times more valuable than silver because silver is 16 times more abundant in the Earth's surface doesn't explain much to me. People pay a lot of attention to it, and I think it's actually become a factoid. I think that when people quote that number, they actually impact the market's perception and the market's action. I'm just not sure why the statistic is the most volatile, highly valuable commodity on the planet. The ratios, at least when I monitored for gold, were much less extreme because gold, although volatile, is nowhere near as volatile as silver. And the time premiums and the volatility premiums in futures markets for other materials seems to be nowhere near as extreme as it is in the silver market. There was also, I think for 40 years probably, an institutional bias that the silver price was declining, while there was a popular bias that the silver price was increasing. So you had a natural war between buyers and sellers on the COMEX. I think that the institutional bias is much less likely to be short now than it used to be. And perhaps as a consequence of that, the volatility will die down. But in direct answer to the question, I don't know of any other commodity in the planet that had the mismatch between the claims volume, which is to say the futures volume, and the amount available for good delivery.
So, Rick, it begs the question, can we have an honest silver market? Is the silver market then always subject to manipulation if it's not a true market structure? And if it is always subject to manipulation, why invest in it in the first place?
Well, the manipulators can only go so long. It is alleged that in my youth, I constructed several short squeezes. Those are short-term phenomenon. I'm not somebody who believes that there's been a 30 or 40-year thoroughgoing conspiracy to depress the price of silver. You didn't have to do it because most of the time the price of silver was going down. Why would you strive mightily to do something that was going to happen via gravity? But I know that all markets in the near term are manipulated. The LIBOR market has been manipulated. The U.S. Treasury market has been manipulated. Those are much larger markets than the silver market. And in a market where the futures volume is so large relative to the amount of available for good delivery, near-term market manipulation, albeit expensive, is really ludicrously easy. If you were going to do it on the short side, you construct a short ladder in the futures market, 3 months, 6 months, 12 months, 18 months, something like that. You develop a good size short position. For fun, we'll call it $1 billion. You borrow a bunch of physical silver and you sell that physical silver as aggressively as you can during the most illiquid part of the trading day, attempting, as an example, to drive down the silver price 3%, 4%, 5%, and have that precipitous decline in the physical market impact the quotes in the futures market. Cover your shorts on lock limit down days, pay back the silver that you owned, and walk away with a profit. I remember in the decade of the 70s where there was allegations that exactly that same type of manipulation happened on the long side. manipulators generally do what's easiest. If there's a negative bias, they try to manipulate on the downside. If there's a positive bias, they try to manipulate on the upside. But the idea that silver markets aren't in the near term manipulated is extremely naive. The reason why one would invest in silver is because